Hello learners, Leon here. Welcome to episode 2 of Leon's Finance Show. If this is your first time watching or you don't know who I am, I'm just an investing teacher, a business teacher on a journey to create lasting passive income. Why, you might ask? Because it's a lot of fun. So if you want to pay attention, if you want to learn something about making money in the investing world, please consider subscribing and liking the video. Without further ado, today I want to give you a portfolio update of what has happened in the portfolio in the last 2 weeks. I also want to go into explaining a little bit about current liabilities, just because a lot of people don't actually look at the financial statements when they buy a company. And so I'm going to teach you how to do that slowly. And today we're going to focus on current liabilities, because I got a question from a viewer. So without further ado, let's get to it. The last time we were here on episode 1, my portfolio was at almost $83,000. Now you notice that it's gone down a little. It has. It's gone down to about $81,000. Now where did that $2,000 go? Now before you're like, oh, Leon just lost money on his portfolio, I'd like to add that you don't actually lose the money until you sell. I have not sold, so my portfolio's market value had just gone down. But why has it gone down? Let's take a look at it. If I look at Bell Communications chart, you'll notice this huge drop right here from 63, almost $64 all the way down to $61. October 22nd, October 23rd. Now, what in the world happened in this day? So I decided to go online and find some news, right? Because if it's something that has to do with a lasting effect on the economics of the business, then I should be concerned. So what I did was I went on Yahoo Finance, I looked at the news, and it says here, Martin Turcotte to retire from Bell in 2020 after a remarkable 31-year career. What is this? Who is this person to cause such a big drop in Bell? Well, it turns out this person is one of the chief executives in Bell Communications. She's the chief legal officer. And so her departure is what prompted this decrease in price, because it was short-term bad news, right? People don't like change, right? So they've decided to sell the stock. Now, does this actually have a lasting effect on the economics of the company? Well, at first glance, I'm willing to say no, it doesn't really have a lasting negative effect. So if anything, this is actually a buying opportunity. All right, so in terms of this portfolio, my book cost is actually about $79,000. So if I actually go into my performance chart, I see a time-weighted rate of return. So what this does is it compares its return with the S&P. Now, because of Bell's drop in the last month, this is now officially about 3% underperforming compared to the S&P 500. However, in the last 3 months, if I look at the results for the last 3 months, it's actually overperformed the index by quite a bit. If I look at the last 12 months, it's actually underperformed the index by quite a bit. And the reason for that is because my portfolio was largely held in cash, and I didn't actually buy any stock until May 22nd, this day right here. Okay, so it was this day when it started going up, and then in September it went up quite a bit. So accounting for the returns for all of these months, this is why over the year it's been underperforming the S&P 500 on a percentage basis. Okay, but this is a more accurate number comparing the last 3 months to the S&P 500. In terms of dividends, what am I actually getting from my dividends for this portfolio? I'd like to add that this is not my only portfolio. I have another portfolio, which maybe I'll go into at a later time. But you'll notice here from Bell Communications, they pay a quarterly dividend of $665. That's some nice change. Hydro One, I get about $120 quarterly. Canadian Utilities about $115 quarterly, and Bridge about $100 quarterly. I think looking forward, I have one share of Laurentian Bank of Canada that I probably should have sold, but I got curious and I just wanted to leave it there to see how it does over time. All right, so as I've said before, I do need to clean up this portfolio. Reason being, I do think I have a lot of weight in Bell Communications, and I'm also really focused on utilities right here. I do have an oil stock, but just because of the nature of dividend stocks, I really like it if the cash flows of the company actually match the dividend payments. And for a company like Enbridge, actually for any oil company, their profit margins actually depend on the underlying price of oil, the commodity. And so I am not comfortable putting my money in a stock that depends on a commodity's prices to give it profits. And so over the future, I'm looking towards investing in some real estate investment trusts in Canada. So in the future, I'll probably create a video series on analyzing rates in Canada and then eventually put some of my money in there, especially as January rolls around and I get another $5,500 to put into my tax-free savings account. All right, without further ado, let's go into explaining current liabilities. All right. I am in the consolidated balance sheets of Apple Incorporated, and we're going to look at current liabilities today. But to begin, you kind of have to know what balance sheets are. Now, balance sheets are a financial statement that lists the accounts that belong to a company and their value. The defining characteristic of all balance sheets are that total assets always equal total liabilities and equity. Down here, 365,725. Up here, 365,725. We won't go into why that happens because that has to do with how accounting records are being kept. But instead today, you can just understand that balance sheets are kind of like a photo of a company. If you took a photo of a company and everything that it had, all the debts that it had, all the money that it has, all the inventory that it has, that's kind of like the balance sheet. And so today we're specifically focused on current liabilities. How do I actually analyze a company's current liabilities? So in order to start, we need to define what current liabilities are. And so liabilities themselves are anything that requires the company to sacrifice a economic resource, and current liabilities requires the company to sacrifice those economic resources within the years. Accounts payable is when you incur a operating expense, but you have not paid for that operating expense just yet. So for example, if you have vendors that you owe money to, if you have suppliers that you owe money to, insurers that you owe money to, pretty much anybody you owe money to, that is a part or as a result of regular business operations. Other current liabilities, similar to accounts payable, but we don't really know what this is. Anything that's not part of accounts payable goes into other current liabilities. Sometimes companies choose to include it, sometimes they don't. And so we don't actually really know what that is unless we read the notes to the financial statement. Deferred revenue is interesting because it's not actually money owed, okay? Deferred revenue is when a client or customer pays us in advance for a service that we will deliver later or over a period of time, or for a product that we will give them later. Commercial paper, you see here, it's kind of like short-term debt, so you can kind of understand it as a line of credit, any type of short-term debt that the company will go into. Term debt here probably refers to the current portion of their long-term debt. So here I am in the consolidated statements of financial position of Target. And so you'll see immediately current assets 12519, total current liabilities 15014. This is an example of when the current ratio, which is current assets divided by current liabilities, is under 1. What that means is the current assets is not enough. there isn't enough current assets to cover the current liabilities. So is that a bad thing? Well, you could say it's a bad thing, kind of, but you could also say that the company will generate enough cash flows in the near future to pay off these current liabilities, so it isn't a cause for concern. That's why these numbers by themselves don't really mean much. What do I mean by that? Well, what I mean is you kind of have to look at a company's balance sheet over time and compare it to see if there's actually any change in the financial structure of the company. So here I am in the consolidated balance sheets of Realty Income Corp. This is a popular stock for dividend investors. Looking at the current assets, I have 155,000 if I add these two together. Looking at current liabilities, which is distributions payable and accounts payable, I see a whopping over 200,000. So just looking at these numbers, can I conclude that a Realty Income Corp is strapped for cash and they can't pay back their shareholders? Well, no, because this is just a moment in time, right? And the company will continue to generate cash flows in the near future. And so I would have to look at the cash flow statement and the income statement to actually see if this is a profitable company. In general, then, when should I actually look at current liabilities? I should look at current liabilities when the company is in a position where it needs to take out debt. So it's in a place where operating cash flows are decreasing, it needs to take out more debt, or it's in a place where long-term debt is becoming due. So for example, if these notes payable are due next year, like if 10% of them are due next year, that's a lot of money that the company has to come up with in a short period of time. I'd be interested in seeing how the company would actually come about raising that capital. But in general, I want to look at the operating cash flows for the year of the company. And if the company has positive operating cash flows and then enough to cover regular capital expenditures and interest expenses, then in general, I'm not that concerned about the current ratio of the company and the current liabilities of the company as compared to the current assets. So, hope you learned a little bit about what current liabilities are and how you can actually look at current liabilities. Anyways, show me some love by subscribing to the channel and liking the video. Leave me a comment and ask a question, and maybe I'll cover it in the next video. Thank you.